Welcome, everyone. I'm Michael Woodford, the chair of Columbia's Department of Economics. I'd like to welcome all of you to our event on the theme of trust in money and government on behalf of the Program for Economic Research in the Department of Economics and the Jerome A. Chazen Institute for Global Business here at Columbia Business School. It seems not that long ago, just around the turn of the millennium, when policymakers here in the US and also in a number of other countries congratulated themselves on having made macroeconomic instability a thing of the past. Of course, declaring history to be over turned out to be premature, also with regard to the problems of economic stabilization. Looking back, we now see that what had seemed to be an unusually stable period, both for real economic growth and for the control of inflation, masked growing imbalances that were largely overlooked until the global financial crisis of 2008 forced everyone to become aware of them. In the aftermath of that crisis, both policymakers and academic commentators now keep a much closer eye on possible threats to financial stability. But it's worth asking whether there might be other kinds of growing imbalances that have also been neglected, though they steadily become more dangerous the longer they're ignored. And I think one candidate for such a neglected imbalance is the way in which public debts have steadily grown relative to the size of national economies over the past several decades, but even more rapidly in response to the crises of the past 15 years. And also the way in which central banks have become increasingly deeply involved in making a market for these large stocks of public debt. To speak to us about these issues today, we're very fortunate to have Dr. Augustín Carstens, who, as you know, is the general manager of the Bank for International Settlements, the international financial organization based in Basel, with the mission of facilitating international cooperation between central banks, particularly on issues relating to monetary and financial stability. Since receiving his PhD at the University of Chicago, Dr. Carstens has had an extremely distinguished career in public service. In addition to his work at the BIS, he's been a deputy managing director of the IMF. More recently, he has chaired the IMF's Policy Advisory Committee. In his native country of Mexico, among other things, he's been both finance minister and then later governor of the central bank, the Bank of Mexico. So he's had a lot of occasion to reflect on the challenges of conducting monetary and fiscal policy and the ways in which each of these can complicate the job of the other one, and from the vantage point of both sides of the street. We could hardly hope for a better guide to the challenges that policymakers around the world are likely to face in coming years. So let's all welcome Dr. Augustín Carstens.
Thank you very much, Michael, for this very nice introduction. Thank you, Glenn, for having invited me here to speak to this distinguished group. Great to see old friends and professors like Jose Sheikman that was with me at Chicago. I mean, he was teaching, I was there just learning, among others from him, to Trisha. It's great to see her here in Columbia. In any case, it's a real pleasure and honor to speak to you today. We're again living extraordinary times. Inflation has surged to levels unseen for generations. Financial systems have come under strain. Recent bank failures are the most prominent example, but not the only one. For the first time in decades, high inflation and financial stress are emerging in tandem. Both have their immediate specific causes, but they are symptoms of a broader and deeper problem. Monetary and fiscal policy have tested the boundaries of what I call the region of stability. This is the constellation of monetary and fiscal policies that, over time, supports macroeconomic and financial stability, keeping the inevitable tensions between the two policies in check. Staying clearly within the boundaries of the region prevents economic damage from inflation, financial stress, and slumps. And it allows policies enough headroom to deal with unexpected shocks. The region's boundaries are elusive. They cannot be summed up in simple metrics like a limit for public debt to GDP or the policy interest rate. The region evolves over time, influenced by long-run forces that shape the structure of production and finance. Macroeconomic policy settings can themselves alter the boundaries. The recent challenge to the boundaries is the latest in a long journey. At each step, the policy choices seemed reasonable, even compelling. But they have brought us to a very complex place. First, tailwinds such as globalization masked what was once a key signal that policies were testing the limits: high inflation. Then, financial liberalization gave rise to a new warning sign: financial instability. Vanishing inflation made many think that monetary and fiscal policy could resolve every economic problem. Policymakers deployed stimulus in recessions, but did not rebuild policy buffers when growth resumed. The pattern became starker after the GFC. When extreme uncertainty prevailed, economic activity collapsed, and inflation hovered stubbornly below target. Given the circumstances, it seemed natural that authorities could use their policies to promote growth without stoking inflation. But their ability to do so relied on aggregate supply adapting smoothly to changes in aggregate demand. This was the case for some time, but when the pandemic made supply conditions unusually inflexible, we saw the magnitude of the risks that were taken. A shift in mindset is called for, retreating from the boundaries of the region of stability and remaining clearly within should be a conscious and explicit policy consideration. Let me elaborate first on the role of fiscal and monetary policies in causing and addressing the immediate challenges of inflation and financial instability. And second, on the forces that led policymakers to approach the boundaries of the region of stability. I will conclude with some reflections on how to return to a more comfortable location within the region. The first major challenge policymakers face is inflation. It has been 2 years since inflation returned with a vengeance. It has become widely entrenched across countries and sectors. The causes have been well documented, including disrupted supply chains, a rebound in demand, and the war in Ukraine. These forces were powerful, but the policy stimulus deployed during the pandemic gave inflation an even larger, unexpected push. Interest rates were lowered to zero or below. Central bank balance sheets ballooned. Fiscal stimulus exceeded 10% of GDP in many advanced economies. In many countries, households received large transfers. Firms benefited from subsidies to keep workers on the payroll. These measures added to demand when supply was constrained, boosting inflation but doing little for growth. The stimulus continued and even grew long after economies started to recover. The policy responses to the pandemic were justified at the time. They kept firms afloat and preserved livelihoods, and they prevented economies from falling into a tailspin. But calibrating stimulus was extremely difficult in this environment. In hindsight, policy support was too large, too broad, and too long-lasting. At first, most observers, including central banks, expected higher inflation to be transitory. And some of it was. Oil, used cars, and shipping are cheaper now than a year ago. In much of the world, inflation has stepped down from last year's peaks. But the next phase of the disinflationary journey is tougher. The easy gains have largely been banked. Services where prices are stickier have become the main driver. Labor markets are still tight. Growth may need to slow more for monetary policy to gain traction. There is no time to lose. The longer inflation lasts, the more likely a shift to a high inflation regime. Households and firms start paying much more attention to inflation, and expectations become the anchor. The genie gets out of the bottle. The costs of regaining price stability grow. Public support waivers for traveling the last mile require to return inflation to target. Interest rates may need to stay higher and for longer than previously thought. If they do, governments will feel the pinch. In much of the world, public debt rose steadily as a share of GDP post-GFC. The COVID-era stimulus has raised debt further, and servicing costs are rising fast. Meanwhile, slower growth will strain public finances. Weaker fiscal positions could complicate central banks' efforts to lower inflation. In the near term, fiscal stimulus rises inflation, partly undoing the effects of tighter monetary policy. Even if higher inflation has helped lower public debt to GDP ratios, this does not provide exploitable fiscal space. Indeed, the IMF expects public debt levels to increase again. And because persistent inflation calls for higher interest rates, it makes high public debt less sustainable. Over the longer term, central banks may come under pressure to slow the pace of tightening to ease the burden of public finances. Even where higher interest rates are manageable, central banks may face calls to take the foot off the brake or raise the inflation target. Larger central bank losses resulting in smaller transfers to the government are adding to the pressures. The second major challenge policymakers face is financial instability. Our outsized, fast-paced, and ultra-sophisticated financial system is fragile, with excess leverage and liquidity mismatches. Financial institutions and markets, including banks and non-bank financial intermediaries, stretch each other to the limit with uncanny regularity. As the edge approaches and confidence suddenly evaporates, fault lines emerge. Wherever the boundaries of stability may lie, this type of financial system blurs their contours. Over the past year, we have once again seen signs of stress. This is no surprise. Banking stress breaks out frequently in the wake of monetary tightening. Larger increase in inflation and higher levels of private sector debt make stress more likely. Now, for the first time since the Second World War, very high private debt coincides with the surge in inflation. And all this has transpired after an unusually long phase of aggressive risk-taking in financial markets. In some recent episodes of financial stress, it is hard to miss the footprint of the cumulative impact of monetary and fiscal policies. For over a decade, many sovereigns issued large amounts of debt at very low interest rates and long duration. The bulk was absorbed by banks, investment funds, insurance companies, pension funds, and hedge funds, which became exposed to the risk of higher interest rates. Expectations of continued low rates shaped business models, fueled risk-taking, and encouraged leverage. This promoted aggressive maturity transformation and liquidity mismatches and amplified the potential for financial stress. Consider two recent examples. Silicon Valley Bank went under because its largely uninsured and concentrated depositor base woke up to high unrealized losses on long-duration securities. A classic depositor run and liquidity squeeze forced recognition of these losses. This triggered broader contagion across medium-sized US regional banks. Problems in UK defined benefit pension funds last year originated from hedges against further declines in interest rates implemented through leveraged funds. As monetary policy was tightening, an unexpected fiscal announcement drove yields up. The hedges generated losses that threatened the solvency of the investment vehicles and prompted a liquidity squeeze. This triggered forced selling of government paper in a falling market. The hedges protected the solvency of the pension funds, but not that of the vehicles in which they had invested. While in the UK episode, concerns about the fiscal position caused localized stress, the damage can be much larger. Doubts about sovereign creditworthiness can destabilize the whole financial system. A sovereign bank doom loop is triggered when banks' exposures to the sovereign put institutions' viability in doubt. Such episodes are more common in emerging markets, but advanced economies have not been entirely spared. Financial crises can also wreak havoc on fiscal accounts and endanger fiscal sustainability. Just as the economy tanks, sapping tax revenue, the sovereign has to step in as backstop. Central banks can provide liquidity, but only governments can address solvency. The fiscal costs can be very large. The risk of financial instability heightens the challenges that central banks face as they seek to restore price stability. The risk would be larger should central banks have to keep interest rates higher for longer. Substantial additional tightening could prompt renewed financial turmoil. And financial turmoil may require the central banks to intervene to stabilize the financial system as lenders or market makers of last resort. Let's look in more detail at the past to better understand how we got here. The journey to the boundaries of the region of stability was not linear. The symptoms of an overly expansive policy stance evolved with the economic landscape, together with more fundamental structural forces. A consistent factor was overestimating of how far macroeconomic policies could be used to steer the economy and ignite the engine of long economic growth. We can think of two phases going back to the 60s. In the first phase, from the late 1960s to the mid-80s, surging inflation was the red flag, signaling that policies had overstepped the boundaries of the region of stability. Recessions were typically triggered when monetary policy was tightened to tame inflation. Policymakers believed they could fine-tune the economy by carefully calibrating the mix of monetary and fiscal policy. The result was the Great Inflation of the 1970s. In response, policymakers tried to bring policies back within the region of stability. Central banks aggressively hiked rates. This exposed fiscal fragilities. With persistent deficits, public debt surged. Many governments were forced into fiscal consolidation. Public debt levels, on average, stabilized. In the second phase, from the late 80s to the eve of the pandemic, changing macroeconomic policy frameworks went hand in hand with fundamental structural change. Financial systems were liberalized. By the early 90s, a government-led financial system had given way to a market-led one. The globalization of the real economy followed. Against this backdrop, the nature of the business cycle changed. Inflation ceased to be the main symptom that policies were testing the limits. The symptoms now took the form of financial imbalances. Inflation-induced recessions gave way to financial recessions. Financial cycles became larger and more disruptive, culminating in the GFC. The shift from inflationary to financial imbalances gradually eroded policy space. Monetary policy eased during contractions to cushion the economy and offset private sector balance sheet repair, but it had little reason to tighten during expansions, given low and stable inflation. Interest rates progressively declined. For fiscal policy, the GFC was a watershed. Financial crisis forced sovereigns to backstop the financial system and support faltering economies. Public debt increased massively, sustained by low rates. The challenges intensified after the GFC. Monetary policy struggled to push inflation back up to target. As fiscal policy sought to regain lost room for maneuver, monetary policy became the only game in town. As time wore on, fiscal policy was then asked to give a helping hand. And then the pandemic and the Russian invasion of Ukraine struck. What does this mean for policy? Let me sketch a broad direction of travel. The immediate priority is to restore price stability. Central banks will also need to address any further financial strains that might emerge. If a high inflation regime sets in, the costs to price and financial stability will be too high. At the same time, we must differentiate measures designed to lower inflation from those safeguarding financial stability. The immediate need of the financial sector must not compromise the tightening needed to lower inflation. Fiscal policy also has to play its part. Consolidation would help to reduce pressure on aggregate demand and inflation, limit the risk of being a source of financial instability, and provide more headroom in case of solvency concerns. As monetary and fiscal policy acting in tandem bring inflation under control, financial instability should subside. The longer-term challenge is to ensure that monetary and fiscal policies operate clearly within the region of stability on a lasting basis. This has to do with strategies, institutions, and mindsets. Policy strategies should aim to keep room for maneuver over time. This calls for more symmetrical policies over the business cycle. Arguably, there is room for monetary policy to tolerate moderate shortfalls of inflation from point target once inflation settles at very low level. In a low inflation regime, inflation has certain self-stabilizing properties. As a result, the central bank can better enjoy the fruits of its hard-earned credibility. This helps to make the interest rate cycle more symmetrical and reduces the need to keep rates unusually low for unusually long, thereby limiting the build-up of financial vulnerabilities. When assessing fiscal space, policymakers must account for the flattering effect of financial booms on the fiscal accounts and the possible costs of financial stress. With respect to the financial system, sound micro and macroprudential frameworks must complement monetary and fiscal policy. This is particularly relevant to allow monetary policy to fully concentrate on the abatement of inflation. A lot has been done to strengthen the financial system. There has been good progress in the banking sector, although recent strains suggest there is still work to do. But reforms have lacked in non-bank financial intermediation, which have grown markedly. Institutional safeguards can limit tensions between the two policies and promote their coherence. Central bank independence remains key. Mechanisms to encourage prudent fiscal policy should have greater bite. Ultimately, though, what matters most is mindsets. Policymakers must acknowledge the limitations of macroeconomic stabilization policies. They can be a major force for good, but also cause great damage. The journey I have described shows that if the specific challenges evolve with the economic landscape, the root cause of failures does not. To generate resilient and sustainable growth, there is no alternative to working on the supply side of the economy. Structural reforms are politically difficult, but there is no free lunch. The region of stability concept, hard as it may be to apply in real time, embodies a recognition of the limitations of macroeconomic policies. The region is not a number or even a set of numbers, but a way of looking at the world and guiding policy. It can help preserve the all-important trust that society must have in the state and its decision-making. Thank you very much.
Just to give you all a sense of a run for the rest of the discussion, I'm Glenn Hubbard from the Business School in the Econ Department. You've met Mike Woodford. Mike is the Economics Department chairman, but that's just a rotating punishment handed out over years. He's actually one of the world's greatest monetary economists. Trish Mosser is a former central banker and head of the Program for Economic Policy Management in the School of International and Public Affairs. We're each going to give a short perspective on Augustin's remarks on the region of stability. Ask him for a little response, maybe a few questions, and then we'll turn it over to you. So be thinking of that. Trish, I'm going to ask you to lead off.
Sure. So hello, everyone. Nice to see everybody this afternoon. Lovely to see Augustine again.
Thank you.
Thank you very much. That was an outstanding and scary summary, frankly, of the macro policy challenges the world's facing right now, I think. I have a couple of comments, and I'm going to intersperse a couple of questions as I go along. My first comment is about the monetary fiscal policy mix. Wow, that's like an old-fashioned term. Both a terminology and a topic that seems to have fallen out of fashion in the last decade and a half, but obviously should not have, as your talk rightly points out. But I don't disagree with your boundaries argument. I think that's a very sensible way to think about it. But I do want to play a little bit of devil's advocate on what's happened in the last 15 years or so. Your assessment of the policy mistakes made during the pandemic is absolutely spot on. But isn't it a first order matter? The biggest problem, the first problem, was one of policy calibration. Let me be specific about what I mean. That basically the modelers and the policymakers just grossly underestimated the combined power of extremely easy money and extremely easy fiscal policy. Looking at normal times is not a guide to that. There's a certain amount, over the years, there's been some evidence, particularly after the global financial crisis, that old-fashioned Keynesian multipliers get multiplicative when both monetary policy is easy and fiscal policy is easy, and they're much, much more powerful. Another example of how nonlinear the world is, the economic world anyway. And so after the global financial crisis, I believe many policymakers walked away thinking they hadn't done enough. That's why central banks on the fiscal side, or maybe they didn't go on long enough. Certainly that was the view in the United States. And the lesson from that is don't make the central banks be the only game in town, because you can't get inflation up and you can't get the economies to grow enough. And so they corrected this mistake, really overcorrected it in COVID by going massively overboard on the fiscal side, monetary policy side too. But that was exactly when supply was constrained and the financial distress never showed up. That seems like at least partly a calibration exercise. So my question to you, it's a counterfactual actually. If the fiscal monetary mix had been better after the GFC and we could have gotten back to regular inflation, we could have gotten back to growth and interest rates could have normalized, do you think our financial distress concerns would be less today? And I won't predict what would have happened during COVID. Or frankly, do you think the fiscal part of this is kind of irrelevant and your talk suggests that monetary policy makers basically probably should have normalized rates pre-COVID more quickly than they did? So that's my first question. Want to go on? Okay. Second comment is about the nature of fiscal policy. Monetary policy is one size fits all. It's a very gross tool. Fiscal policy is exactly the opposite, right? It's a diverse set of tools capable of helicopter money, pure demand stimulation, a la COVID, just write everybody a check and encourage them to go out and spend it, or alternatively being potentially being very, very targeted, for example, to structural changes in supply. Given that so many countries are going to have limited fiscal space in the coming years, I'd be interested in your views, and interested in Glenn's views too, on what part of fiscal policy recalibration might be most helpful in the years ahead. So that's my second question. Last but not least, I just have to say something about financial stability because I spent a big chunk of my career working on it. For at least a dozen years, everybody and his mother in the financial stability world, which I used to be one of those people, has been saying that the buildup of leverage, of duration risk, of illiquid, nonlinear credit instruments with daily liquidity redemptions, and opacity, particularly in the non-bank sector, was a prescription for financial instability in the future. It's a bit like crying wolf. Didn't do much good. Now, in some cases, countries did deploy macroprudential tools, but of course they removed most of them during COVID. And in addition, most macroprudential tools are very, very focused on the largest global banks. The sad truth is that most of the risks I just listed were major contributors to the panic during the global financial crisis. But with the exception of addressing regulation around the largest global banks, almost nothing has been done to address them. Frankly, regulatory systems and the financial safety nets are shockingly inconsistent with the actual structure of the financial system globally and the systemic risk that it poses to economies. And unfortunately, I'm afraid that if history is a guide, that it's going to take another crisis, unfortunately, to actually fix things.
Okay, Mike?
So I'd also like to really thank Dr. Carstens for that wake-up call. I think we have
Yes.
a lot of reasons to be concerned with recent trends in policy and with the lack of a clearer sense of what the rules are for when we're going to use particular policies. With regard to the question of the interpretation of the idea of a region of stability that we should be concerned about straying out of, I think there is a question of whether one should really think that that simply means we should never be willing to deviate from typical approaches to policy. It's not clear to me that the mere fact that the policies, for example, in response to COVID were quite unprecedented means in itself that they were inappropriate to the moment, or at least that doing something quite different from business as usual wasn't appropriate to the moment. In particular, I think your remarks emphasize the idea that there was an excessive fiscal response and that perhaps this didn't do that much for economic growth, although it boosted inflation. And I think it's clear that the policies, the fiscal responses that we had weren't very well targeted, and they probably did go on then farther than it was necessary to do. But I actually think there's more reason to criticize the monetary policy response than the fiscal response as something that was unwarranted and, in fact, excessively inflationary. And the reason relates to the type of shock that had just hit the economy, which it seems to me was one that if any kind of economic shock justifies the use of fiscal transfers as a response, this was almost the textbook case of it, because what happened suddenly cut off normal sources of income to many people in the economy, but concentrated in very particular parts of the economy, not at all to people equally. And it was not the kind of shock that that monetary policy was at all well suited to deal with. So it's true that economic activity was abruptly and rapidly slashed, but not for reasons that, say, cutting interest rates or even buying a lot of longer-term bonds, adding them to the central bank's balance sheet, would do that much about. Monetary policy can stimulate spending, but in this particular kind of case, the people for whom it could stimulate spending, which would be the people who are not particularly credit constrained, were not the people who, to have a more efficient allocation of resources, one needed to make it possible for them to spend more. And instead, fiscal policy was very well suited to do that. Even if it was a relatively untargeted fiscal policy, at least it got checks to the people who were badly in need of some way of continuing to be able to spend. And of course, it's possible for fiscal policy to even be more precisely targeted, and that's also an advantage in dealing with that kind of a shock. So it, on the other hand, seems to me that the monetary policy response was not at all justified by what had happened. It was not a type of shock that should have made one think that interest rates needed to be lower in the economy at that point in time. And in particular, it was, I think, a mistake not to realize that the strong fiscal response that had happened, which was very different from previous crises, was one that should have meant there was much less need to respond with the monetary policy playbook that was used, and I think that was pushed much too far and continued for much too long. Now, with regard to the longer run issues being addressed in the talk, I think I have a lot more sympathy with the view that fiscal policy is something to be very worried about. I think that if we're asking what's concerning about longer run trends in stabilization policy, there's a lot of reason to worry about what seems to be the long run trend of fiscal policy, which is to move toward larger and larger expansions of government debt and never the retrenchment, only moving further and further into new territory, and more reason to worry about that actually than the trend, I think, of monetary policy over recent decades. But also here, I think that the idea of saying, well, what we need to just tell people is never to cross certain lines that take you outside the region of stability is not necessarily what I would say. I wouldn't say that we need to avoid ever using these unusual tools, avoid ever using fiscal stimulus, avoid ever using lower for longer monetary policy commitments, or ever using central bank balance sheet policy. Instead, it seems that it's important to limit the use of these special tools to times when they're genuinely needed. And so I think that what people need to think more about is the need to undo these policies and offset them at other times exactly in order to create more policy headroom to use those special tools at the times when they're especially valuable.
Well, thank you, Augustine, especially for being here. Just offer a few remarks from myself, and then obviously love to hear your thoughts on anything we've all said. I thought your image of a region of stability is a very good one because it emphasizes a region and not a point. There are, for many of the reasons Mike said, this is going to be a complicated journey. As I listened to you, I thought about the root word from Latin for credit, credo, I believe. This is essentially a story, whether it's about financial markets or about public policy, about trust. And I think of that in two elements, and you mentioned both, but one a little more than the other in your remarks. One is about financial markets and monetary policy, but also something I want to come back to about political economy of some of the policy errors that you mentioned. To policy, if we take ourselves back to 2008, remember the fiscal policy debate of targeted, timely, and temporary. That's beautiful alliteration. It was also wrong as a policy response. Monetary policy was also very halting. We, for better or for worse, unlearned those lessons going into COVID. And now we're confronted more with metaphors from policymakers of driving in a fog. And if you drive in the fog, driving either too fast or too slow can cause an accident. Like Mike, I think that's more of a problem for fiscal policy. I think monetary policy is the one where the bigger errors were made. I think it was pretty clear that monetary policy was not doing what it should have done during the COVID period. Going further back, we could ask how wise it was that policy was so easy for so long, and what were the buildup that we could have expected for bank and non-bank financial institutions. Building on something Trish said, I've worried for some time about the marriage of three factors: the desire to provide great liquidity for the public, to do so in relatively opaque instruments that are also subject to a great deal of interest rate risk. That is not a healthy cocktail for either bank or non-bank financial institutions. Returning to the issue of trust, it strikes me that there's several layers here. One begins with the central bank. The Federal Reserve here, central banks in most industrial democracies have a lot of work to do to rebuild their credibility with the public, starting with their commitment to inflation. They also have a great deal of work to rebuild their credibility in explaining what they do. As Mike was reminding us, the difference between responding to demand shocks and supply shocks for a central bank. Central banks in this country and in most countries are also very heavily involved in financial regulation. And here there's an ultimate need to build up credibility again in thinking about supervision and banking and what we want financial institutions to do. But the biggest thing on my mind in listening to the remarks this afternoon is rebuilding trust in the presence of two things, both of which have already come up in this conversation. One is about unsustainable fiscal policy. That is truly the low-frequency, gigantic problem of our time in terms of an ongoing policy error. In terms of the link to central banking and to banking itself, there are real constraints on central banks in an era when the public sector simply isn't apparently cognizant of the intertemporal budget constraint. In terms of what to do about it, I liked very much in Augustine's remarks mention of things like independent fiscal councils. We've learned from some countries, Sweden comes immediately to mind, of the success of such organizations, but it will be a huge challenge for central banks and policymakers. The second area of trust that didn't get as much discussion here, but I think in terms of the politics of this is even more important, is a political economy concern. The policies that were pursued in the great financial crisis and again during COVID did two things. One, they exacerbated income and wealth distribution problems, not as a deliberate goal of the policy, but as a corollary of a policy to keep rates very low, thereby inflating the value of assets, good for owners of assets, and a perceived failure in much of the public that certain institutions or types of businesses might be bailed out, banks, in the case of a global financial crisis, once again in the present period, as opposed to other situations in the economy, homeowners in 2008, small business people today. I say that not to question the wisdom of the particular policy moves, but the absence of political economy concerns. So just to wrap up where I began, I do think Augustine has done us a huge favor both by defining this region of stability and pointing us back in this direction of trust. So why don't we let you chat with us about any of that? We'll talk among ourselves, but loudly, and then turn to all of you.
Well, thank you very much. I hope they give me a degree after I answer all these questions. No, excellent questions, and I think this will allow me to clarify some views and, well, obviously to express. In general, I would say high level of coincidence with many of what you have said. It's probably more an issue of nuances. Let me start with Tricia. Your first question, you mentioned a lot policy calibration, and I definitely think that's the key issue. I said it in the speech. I think also, and this has to do with a response to other of the comments that have been made. And it's something that we need to see how certain is what I have to say. But, we came from over a decade where monetary policy was very aggressive and nothing happened to inflation. Then came the pandemic in particular. And we have to remember that the pandemic was considered first a major deflationary shock. I mean, the expectation was that the economies were going to tank. As a matter of fact, they tanked. That, the floor was pulled out of everybody. I mean, I think it's the first experiment where we try to eradicate the pandemic by bringing the world economy pretty much into animated suspension. Nobody works, nobody goes to the offices, you just need to survive. So, I mean, what was the expectation about growth? One reason for monetary policy to act within limit is there was huge concern about the survivability of many, many firms, especially when you mention the distributional aspects. I mean, which are the weakest links? Small, medium-sized enterprises, family houses, things like that. As a matter of fact, if you remember, a lot of the programs that were implemented were geared towards those firms. Now, if that wouldn't have pushed forward, I think that the consequences would have been extremely, extremely grave. I think that the real surprise was that the rebound was very, very fast. Part of it because of the vaccination, which obviously was welcome, but also about the fiscal response. Now, you can say that the Fed acted a little bit late or quite late, or I mean, I don't want to use it in objective, but it was a matter of weeks or months, more than weeks. And actually, it really became very seriously once the Ukrainian war came in. A major debate among central banks is the issue, how much is temporary, how much is permanent? And the dogma of, the doctrine of central banking is that if you have a relative price change, you should not try to bring down inflation in all the other goods and services in the economy to hit the right aggregate. I think that affected a lot of the policy making at that time. Also, and here I have to say the political economy was also a very important factor. Central banks just didn't want to abort the nation's recovery. And we are coming out of a huge shock where, nobody was working, nobody was going to university, nobody was traveling, services were collapsing. And then suddenly you come with a very strong response from the central bank that's very difficult to engineer. So I think calibration, yes, was an issue. And it was not only, and I think what was the most important shock is how we went from a situation where aggregate demand stimuli could be met seamlessly by the aggregate supply. For me, this is the key issue. And suddenly came the pandemic, where supply got completely distorted, and this one then additionally distorted by the war to Ukraine. So suddenly you come from a period of at least 15 years or even more with globalization, with value chains, all of those things where you could push and push and push and push, and aggregate supply was there all the time, to the point that it was very, very difficult to increase inflation. So in a way, I think that what was very difficult for central banks to do was precisely to calibrate the response in the face of those responses. I can tell you that if we had a crystal ball and we could have anticipated this more sticky response of supply to aggregate demand, it would have been far more careful. One of the things that we didn't quite anticipate was the shift in the pattern of the demand for goods. It went from services to goods and then back again. That distorted hugely prices. relative prices. So I would say that the monetary policy response in the face of the pandemic was due to three factors, I would say. One, the fact that we didn't anticipate this stickiness in aggregate supply. Second, the fact that there was a lot of fear about the impact on the productive sector, a part of the productive fabric that would have been washed out in the face of without interest rate support. And there was also some concern about financial stability. And there was a mixture of market functioning plus monetary policy, because if you remember in March 20, there was huge volatility and there were huge concerns about the financial institution. So it was a moment where I think central banks, this is my own saying, I didn't hear anything central banks saying this, but I think if you had to err, it was probably to err in that direction. Because given the history that we had before, the threat of inflation, ex post, yes, but at that moment it was not considered to be that large. So policy calibration is very, very important. Yes, fiscal policy need to be more targeted, and yes, it's a classic case what we experienced then, but probably was a little bit excessive, in particular in the US. No, and the issue is that in the minds of people, we still don't see much of a concern about fiscal policy going forward and the impact on inflation. And I can say that is quite important, and it's something that we cannot forget about it. But then, and you know, this is a matter of also of my explanation of why we were going so many years back. And I think that in particular, how to address aggregate supply and to have a serious discussion about growth is quite absent. And I think that is probably one of the key aspects I wanted to highlight here. We have got accustomed of using too much and too quick fiscal and monetary policy to stabilize things. I agree with Michael that you know, in the face of some shocks, you really have to use this type of instruments. But do we need to do a permanent policy carried over decades and decades and decades, tracking so much economic activity and not worrying too much about the consequences of what I can do that can haunt me many years into the future? And shouldn't we start thinking more about really how can we engineer higher growth? The discussion about growth today is mostly a discussion about fiscal and monetary policy. And I think there, as a profession and as policymakers, we have far more to do. Now, financial stability, yes. With the benefit of hindsight, it's difficult to think that low for long was going to last forever. And therefore, I think we need to mind this. I think that, I mean, as you know very well, the work of the Financial Stability Board, the work of the Basel Committee is very slow moving, although the issues are on the agenda. And I really think that we need to move faster. As a matter of fact, I would say that if you analyze the events surrounding Silicon Valley Bank, if you analyze the problem with Credit Suisse, I think all those events had been contemplated in Basel, in the discussions of Basel. And well, one of the problems that we have with the key regulation, at least at the international level, is that it establishes floors. But then the countries themselves can have the flexibility of building on that. In some countries did, other countries didn't. No. So I think, I mean, for example, something that is quite discussed today is we need to put or we need to address the interest rate risk in the banking book. Australia, for example, have dealt with it for quite some time, and they have done it quite well, you know. So I think it's an issue of the discussion is out there, then how quickly is that mapped or mirrored into actual regulation and supervision. And I think that's a big challenge that we have in front of us. I think of what you said, Glenn, about trust. I agree with many of what you said. But going back to one criticism or comment that I think it's very important, it's about the impact of all these policies of income and wealth distribution. Again, here the instrument is not necessarily fiscal and monetary policy, especially when you have to use them really to stabilize major problems that you have in front of you. Yes, I think it should be a consideration, but should not be a major impediment. I think, as I mentioned to you, I think that quite some of the measures that monetary policy did in terms of programs, in terms of guarantees, and so on and so forth, was also to protect some of those people. I definitely think that the role of fiscal and monetary policy has to be better defined. I think one of the good things about the autonomous laws of the central banks is that it's a very important discussion of the reach of monetary policy, and that is manifested in the law. Sometimes it's very clear, sometimes it's not as clear as you would wish, but it's an advantage, and I think to have that type of discussion in fiscal policy would be very important. At the end of the day, you need some social consensus about what these policies can do and should do, and that's a way forward in having that discussion at the national level. But for me, and here this allows me just to close, to put the nuance I want, is not so much that we should forsake these instruments, but is at the same time, we should not get used to them as our instruments of first resort. And also, I don't think we can really expect to engineer high and sustainable growth with much better income distribution just by using fiscal and monetary policy. And my sense is that debate about how to get growth going is not out there. It takes a long time. It doesn't have it doesn't lend itself for authorities showing concrete action that you can show with a yearly budget or with monetary policy. But so, I mean, at the end of the day, if you ask me what we should do, given that fiscal and monetary policies have depleted, or they're close to deplete their power to continue pushing for growth, we need to find how can we give more breathing space to the economies, and how can we engineer sustainable growth with stability as we move forward. And there, I mean, certainly monetary and fiscal policies should continue to do as much as they can within limits. Monetary policy certainly has to be devoted to abate inflation, because inflation will not help us at all in any way. We need to enhance financial regulation and supervision, because that certainly the separation principle is important, and we have to make it clearer and more resilient. And we need more growth. And if we have more growth, there will be more degrees of freedom at the fiscal level. And that also, especially, fiscal policy, for example, can be used to tackle the issues of the bottlenecks that the economies are facing. If we spend more in infrastructure, more in productivity enhancing activities, and not so much in transfers, I think we probably would be doing a much better job. So if we have more growth on a sustainable basis, that will give more breathing room to fiscal and monetary policy, and with much better regulation and supervision, we would also give more breathing room to monetary policy to be more effective to abate inflation. So there is where our thoughts is going.
No, that's great. I do want to make sure we have time for the audience, but I did want to ask you a follow-up on what you just said, Augustin. How do you, as a prominent international official, how do you advise central bankers to talk in a world to prepare policymakers for a little bit less hyperactivity, more of a concern about structural reforms, especially in a world where, of course, central banks have to realize, commenting on fiscal policy, a source of many of the concerns, might be a bit beyond their ken. How do you finesse that conversation?
I definitely think that there is no one size fits all. I can tell you, when I had the privilege of being governor and minister of finance. So I have seen the game from both sides. And in Mexico, the central bank has some space to say, fiscally, we need this and this and this and that, because if we don't consider the interaction, the actions of monetary policy will have to be adjusted. There are other countries in Europe, for example, where this can happen. There are other countries, like here in the US, where the line is more clearly cut. But I think at some point, if it's not done at the public level, at least at the academic level should be done, I mean, you have to respect the practices and the limits. But I think that it's something where it's very difficult to clearly cut the effectiveness or the description of the effectiveness and the actions of one policy without addressing the other. Monetary policy should be, in normal times, should be sort of predictable. Fiscal policy can have more changes, but especially as you move intertemporally and you get closer to the limits of the boundaries or to the boundaries of the region, I think more public debate about this is important.
So I've got plenty of questions for the panel, but let me take a break and turn to audience for questions. Let me just quickly repeat so people who are listening YouTube later will be able to hear everything. The questions about structural challenges, about why stagflation could be so bad. Answer, I lived through it, it is. We can talk offline if you like. And then AI, so over to you.
Well, I'm glad that you rose those issues. I think that's a very important part of the debate we will have to have. I mean, huge technological development. We know that technical progress is a very important determinant of growth. It could have a major impact on labor force participation, of income distribution. It could affect the productivity. That's key discussion to have. And to a large extent, that is independent about what happens between fiscal and monetary policy, you know. If all those developments are very positive, and you know, we have higher productivity growth, we will have higher real wages, and probably the pressure on certainly that will shift aggregate supply, and that should help reduce prices in the economy. So I think for me that's the type of discussion we should be having, no? Not concentrate only on fiscal and monetary policy issues.
Questions about financial stability. If one took mark-to-market logic to private equity, to real estate, are there other shoes to drop?
Yes.
Well,
Sorry.
Go ahead and elaborate.
If mark-to-market treasuries and a very badly managed, concentrated, weird bank could bring down the bank, not marking to market. Marking to market's the wrong way to talk about it. Illiquid assets, what you need to do is recognize your losses, right? Banks have to do this, they're required. What goes on in the less regulated part of the credit world is who knows? And of course, the first inclination when you're facing losses like this is that everybody wants to say, well, but it's going to come back. You know, it's not really that bad. The problem is that we probably enter the central banks, because inflation is the worst, is the even worse outcome, need to slow down the global economy a lot. And in the advanced economies, they really need to slow down the economies. You slow down the economies, and nearly always, it's going to be the riskiest credits and real estate that are nearly always going to suffer. And so the question is, how soon do those losses get recognized? So I won't say a lot of marking illiquid things to market leads to a huge amount of sometimes excess volatility, frankly. But recognizing the losses that are likely coming in low quality credit and in certain areas of real estate, not just in the United States, but in a number of places around the world, is probably going to be a very big deal in the coming, my guess is in the coming year or so.
That type of event is the type that probably was more anticipated and more reflected in the reforms that were done post-GFC. I mean, with the distinction that in the US, the non-bank financial intermediation is very, very large, very sophisticated. And that doesn't necessarily happen, is not reflected in the rest of the world. I think that many of the official supervision and regulation has concentrated on these sectors. And I think for the banking system, seem that this should not be a major issue. Now, for non-bank financial intermediation, where there is a lot of opaqueness and so on and so forth, yes, I mean, there might be some risks, and that's one of the reasons why I fully share the view that we need to dwell far deeper into those forms of financial intermediation.
If I could just add one thing, one area which I think we may want to worry a little bit more is on certain types of open-end funds, open-end mutual funds that are providing instant liquidity against very illiquid assets. At times in which there's not much fluctuation, that might be fine. But of course, that's the same logic. That might be fine argument is the same argument about that Mr. Becker made with Silicon Valley Bank. Well, as long as people don't take all their money out, we'll be fine. That's not true. So I do think there are pockets where we want to look for, as I was saying, marriage among liquidity and opacity and rate risk. Anytime you see that, that's at least an area to consider. Other questions? Yes, ma'am. Questions about the Federal Reserve and the Financial Stability Oversight Council, and any broader lessons learned for policymakers?
Well, I mean, definitely there were some very specific US-centric events that definitely are important to reflect on. And I think that's what the Fed is doing now. And I think that will be very, very important. I mean, I think among others, the interest rate, the interest rate, how to deal interest rate with interest rate risk in the banking book, issues of a key aspect, and you know, this also applies to other countries. Probably it hasn't been manifested with the same intensity, but I think it's relevant for all the global banking system. The issue, for example, of how sticky deposits are. That's a key aspect that will need to be considered. How to deal with, liquidity coverage ratio in the face of considering some assets held to maturity. Are they or should not be part of the LCR? Issues that now also will have to be discussed is the discussion between deposit insurance and how strong do you need to have regulation, but also the issue of resolution. All these discussions are important thoughts that every banking system should have today. And you know, we also had this major issue of Credit Suisse, which was a very important global systemic financial institution. And that also need to be reflected in the debate. And in particular, the issue of resolution. I think that, yes, this is, I mean, in a way, it's important to have these moments in time where we can seriously rethink on where we are and what else needs to be made, what else needs to be done to have a far more resilient financial system.
Questions? Yes. Issues with opaque credit agreements between China and other governments.
I don't even understand quite well the question, but I don't think that's a major issue right now. I mean, there are many issues with respect to how China is participating in some debt relief operations, and I don't think that this is reflected there. Yes, the Chinese government has granted, the PBOC has granted a lot of swap agreements, contingent swap agreements to some central banks, but that's not an issue that will make more vulnerable the financial system. In some cases, it might even help. Yeah, it's an issue that I don't think it has particular relevance for the discussion we're having today, or the key discussion we're having today.
Let me do a quick lightning round with everybody as we wrap up. One issue that's come first in your excellent speech and then in the discussion surrounds a role that fiscal policy kind of plays in the middle, either as a contributor of stability or policy errors, potential intersections with central bank policy. Can we get to a fiscal consolidation without pain and a crisis in the United States and other industrial democracies? I know we can as a matter of economics, but I'm asking you, can we as a matter of political economy? And if so, please tell us how. Mike, start with you.
Well, I'm not going to offer you the easy political solution. I think you're right that there's a variety of choices, and so it's not that there's even one single thing is the only economically possible solution. Political process and not technocrats, I think, who need to decide what the desirable level of government is, and therefore how much funds have to be raised to pay for it. But I think the thing that economists can remind people is that, particularly over time, not necessarily on a year-by-year basis, but over time, there has to be a plan for how you pay for things, and enacting programs and simply not asking how are they being paid for isn't something we can.
Okay, Trish?
So I'll stick to the United States here. The United States will probably, at least for a little while longer, because of exorbitant privilege, get away with not being as fiscally responsible as it should be. But there is a limit to that. And the problem is that limit may be pretty ugly. So I share your political concern that when it hits it, it will not, it's going to be ugly for the dollar, it's going to be ugly for US economy. And I am a little concerned that given the political dysfunction these days in the United States, that it's going to take that sort of a really bad event to sort of wake people up in Washington. Anyway, not to be too pessimistic.
I think it's very important to have at the national level continuous debates about the long-term sustainability of the public finances. The risk of not having that are extremely high because when you realize that you are far behind the curve, things can unwind extremely fast. I think also from a political economy point of view, you cannot do many of these huge structural reforms from a public finance point of view all at once. I mean, for example, if you have a very low tax income, and then you have a huge imbalance in infrastructure, and then you have also a very large actuarial deficit in the social security system. I think it's completely irresponsible to wait until the thing explodes to start tackling the issue. So I think there should be a debate, and every Secretary of the Treasury or every Minister of Finance, as it was my due, I, for example, increased for the first time in many years the value-added tax. Probably one of the reasons I ended up in the Banco de Mexico, it was because of that. So I basically passed to a better life because it's much nicer to be in the central bank. But you know, there should be an action, a major action, almost in every single administration. Otherwise, it will not happen. Now, politics, yes, it's tremendously difficult. But that's why you have to have the debate. There is something that needs to be pushing the political forces to the point where you have to mind this long-term equilibrium. Because if not, it's very difficult to make. Also, each administration has to do something in that line. Otherwise, this does not converge.
Let's give you a chance for any last word you want to give us on your remarks on the region of stability.
Well, let's help us develop the idea. I mean, this is for us to have this. I mean, here you have very important thought leaders. We have learned a lot from you. We need to have this type of discussions where we try to bring everything together and try to have a better gauge of where the economy is going and where the key stress points are. Because also there are stress points that if something breaks on the fiscal side, it probably will affect monetary, and if something breaks in the monetary, will affect fiscal, and if something breaks in financial stability, it will affect the two others, and if something is not done with these three, it will suffer growth. And then what do we do about growth? We tend to discuss too many things in isolation, and therefore it's important to have a broader discussion and also to have better guidance towards for the politicians, as much as some they don't use any instruments, but some for many of them they're very important. So how can we have better metrics of how to conduct the public policy, because otherwise the trust in government could suffer.
Please join me in thanking Dr. Carstens